Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We've seen some rather worrying data out of China today. The manufacturing PMI, that's the official data, which is just a sort of a basket survey that's 10 times larger than the small Caucasian survey. So it's the one that really matters. It includes the state enterprises as well. That came in at 49.2, which is significantly in contraction territory for manufacturing. Now, the interesting thing about this, it's only been up to 50.1, 50.2, 50.3 for a year or more now. So basically, manufacturing in China has been flat to contracting for a full year. That's not a good look. So, I mean, there's still hope that something happens coming out of COVID, but the Chinese economy, as I've been saying for some time, really is resetting to a lower economic trajectory long term. I noticed that some of the other big investment banks around the world are now joining our view, which we've held since the third quarter of last year, that China GDP is probably, for many years now, a decade or more. I used to say a couple of decades. The market sentiment seems to be adopting for the next 10 years. But we were saying a full year ago that the outlook for China's GDP was really 2 to 5% growth per annum over the coming 1 to 3 decades. And they are good numbers by Western standards, but terrible numbers by the recent history of China. But of course, it isn't fair to compare those growth numbers with the recent history of China, because the recent history of China over the last sort of quarter century has really been about an economy making the fastest changes in its actual construction since, well, perhaps ever in history. I mean, it was a more powerful experience than even the industrial revolution, in that what we've seen is China move from an agrarian economy to a capitalist consumer economy in a very quick, short period of time, and then to continue to expand and specialize and adopt technology in a very fast, quickened pace that's seen, really economic GDP numbers in the order of 8 to 12% is what the world had become used to. Now, I remember about 5 years ago or even 10 years ago, all the economists of the United States saying, this is terrible, this rate of growth. China needs to slow its economy to more sustainable levels. Now that China's economy has slowed to more sustainable levels, all those same economists are coming out and saying, oh, look how bad China's doing. Well, China's doing better than the USA, better than Europe, better than the UK. It's the world's second largest economy. The US economy's grown 0.4% this year. China is doing a lot better than that. So China remains the powerhouse, equal at least to the United States in terms of contributing to global growth at the present time. And this is a good thing, particularly for the Asian economic region. Now, we saw some factory activity data out of Japan today that was worrying, but we saw strong retail sales. So Japan also needs to be careful, and I would not be too enthusiastic about expecting Japan to be hiking interest rates aggressively anytime soon, even if inflation does tick up, because as I've been saying for some time, that economic recovery there is firming, but it's by no means alarming. So I think the Bank of Japan will continue to intervene in the currency market. It will begin to talk about interest rate hikes, but I don't see any aggressive rate hikes in Japan anytime soon at all. We've got a lot of interest rate activity this week, several central banks meeting. I think the Bank of England could surprise the market by being on hold at current rate settings. Though, of course, the inflation numbers there are indeed alarming, and that may continue to tilt their hand towards hiking. But at the same time, their economy is under a lot of stress. They do have energy problems, and we've just seen 3 prime ministers in 2 months. I don't know whether the Bank of England will read that as, well, we need to give people a little bit of breathing space so we won't change rates, or whether they'll read that as, we need to reassure people that we're stable at the Bank of England and continue to hike rates. So they will be factors in their thinking. If they're not stated, they will be implicit. So nothing to a small hike by the Bank of England, I would think. The Federal Reserve, we know they're going to hike by 75 points. How can they not? They've said all along that they will raise interest rates even if there is economic pain. Inflation remains alarming as well in the US, so they'll definitely be hiking. Now, the interesting thing is the Reserve Bank of Australia will probably be hiking as well. Now, everyone's expecting a 25-point rate hike. There is a chance they'll do a 50-point rate hike, but that would sort of tell the market they made a mistake last meeting, and the RBA never likes admitting its mistakes. I did write an article today where I said I forecast 50 points, and that's really to highlight that that risk is on the table, but it's very difficult to know how I often feel the RBA is more interested in managing its persona and public image than it is correct economic activity. I think the RBA should hike by 50 points, but I also thought they were probably right in hiking by 25 points last meeting because the economy is showing a lot of struggle in Australia, and the government has admitted that it is. So that's why they slowed to 25, but then we got that alarming inflation data, 7.3% for the headline inflation, but it was the core data above 6%. That's, I think, perhaps one of the highest core inflation rates in the world at the moment, and it means that inflation has taken hold strongly, firmly, broadly across the economy, which is something we were saying over a year ago. But certainly the data has come to reflect our view rather accurately on inflation and how central banks would be responding to that. What does all this mean for markets? It means that markets have been momentarily euphoric where they can about earnings out of the US, but then again, they can drop quickly if there's disappointing earnings. We've seen the disaster with Facebook Meta. We've seen couple of better earnings elsewhere, or better outlooks perhaps with Apple. But again, everything has a question mark over it as we go into the November-December period where things in Europe could intensify or deteriorate a little bit, and that could weigh on markets as we move forward. Not a lot of people are expecting that. They're expecting the war in Ukraine to remain a stable sort of situation, but I doubt that very much. And Russia over the weekend said it's withdrawing from the grain deal, which again means that the world could be facing food supply disruption. They're doing that because they have said that they destroyed about 14 underwater drones as well as air drones, which attacked the Crimea naval base on Saturday. And they believe that some European powers had troops involved in that attack, or more direct involvement, which could mean things are getting a little dicey. And as we move into the colder winter period in Europe, there is the risk of another wave of Russian assault against Ukraine, unfortunately, and that could weigh on markets as well. But the interest rate hikes coming as they do after the market's already got a little bit euphoric could suggest a little bit of trouble further down the line for US stocks and for Australian stocks. With regard to the Australian dollar, really an RBA rate hike of 25 or even 50 points is still bearish the currency. And I say this every RBA meeting. The reason it's bearish the Australian dollar is because the Fed will be hiking by 75 points, significantly more than Australia. So that every RBA and Fed meeting, the gap between the US yield, the US cash rate, and the RBA cash rate widens. In other words, it just becomes more and more expensive consistently to hold Australian dollars. And at the same time, it's very good as an exporting nation to have our currency weakening. So that will buffer Australia, the Australian economy, against the global economic slowdown, which is now extremely entrenched. I mean, we have manufacturing clearly slowing across China, the United States, Europe, the UK. It's not a good situation. I do not see that buying stocks here, or if anyone is buying the dip here, it is probably again too early, as it has been all year long. So plenty of opportunities there. I still think buying US dollars, I've been saying for a while, it was time to get back into oil, and that is working out quite well. So keep an eye on that oil price. I'm adding to positions there personally myself. And they're the two markets really that seem strong, the US dollar and the oil market. Hope that helps, and we do have all the tools we need to protect our portfolios, but we do have to do that actively in these circumstances and this environment generally around the world. Thank you very much. Have a great day.